Hello, everyone, and a huge thank you for joining us today to watch this analysis.
Yeah, we're really glad you're here.
We are absolutely thrilled to have you as we unpack the latest from Under Armour specifically, their Q3 2026 earnings.
And this was a big one.
Oh, for sure. Whether you are an active investor, a fan of the gear, or just, fascinated by how these massive global brands try to reinvent themselves, we appreciate you spending your time with us.
And reinvent is really the key word today, isn't it? Under Armour is in such a fascinating position right now.
How so?
Well, they are deep in the middle of a massive turnaround effort. And if you listen to this earnings call, you realize this isn't just about tweaking a few numbers. This is a full-scale operational reset.
Right. And usually when I hear operational reset, my brain automatically translates that to things are messy and everyone is panicking. But listening to CEO Kevin Plank on this call, the vibe felt different. He kept using this very specific, almost unusual phrase. He called it unleashing intentionality.
I know. It sounds a bit like a yoga mantra, doesn't it?
It does. But you're saying it's more than that.
Oh, absolutely.
Yeah.
It might sound a bit abstract, but when you actually dig into what they're doing, it's incredibly practical. Intentionality here is really just code for extreme discipline.
Discipline.
For years, Under Armour tried to be everything to everyone, chasing trends, chasing volume. Now, Plank is saying they need to stop the noise. His exact words were that they need to do so much more of so much less.
So much more of so much less. I actually love that line.
Good, right?
It implies they were doing way too much of, well, stuff that didn't move the needle. But before we get too deep into the philosophy, let's look at the scoreboard. How did they actually do financially this quarter?
Okay, so let's break down the headline numbers from their presentation. Revenue came in at $1.3 billion.
Okay.
Now, that's a decline of 5% compared to last year. And, a 5% drop sounds negative.
Yeah, it does.
But in the context of what Wall Street was expecting, it was actually slightly better than they feared.
So they stepped over a very low bar, but at least they didn't trip.
Exactly. But the really interesting part is where that decline is coming from.
It's not across the board.
Not at all. And this is the key thing to understand about the company right now. The pain is highly, highly localized.
Localized where?
North America.
Yeah.
Their home turf.
Yeah.
The market that made them famous.
Yeah.
Revenue there is down 10%.
Yo, a double-digit drop.
In your biggest market, it's a problem. But if you look internationally, the story completely flips.
Really?
EMEA, that's Europe, the Middle East, and Africa for everyone listening, is actually up 6%. And get this, Latin America is booming, up 20%.
20%. That is a massive disconnect. So the brand is hot in Brazil, but freezing in Baltimore.
Essentially, yes. They're winning their away games, but losing pretty badly at home.
All right, what about profitability? I mean, are they actually making money on the gear they are selling?
That's where it gets a little tricky. Gross margin, so the profit left after the cost of making the goods, it fell 310 basis points down to 44.4%.
And just to translate, 310 basis points is fancy Wall Street talk for 3.1%, right?
Exactly. And a 3.1% drop in your margin is significant. It hurts. They're blaming supply chain headwinds and, notably, higher U.S. tariffs.
Tariffs. The headache that just won't go away.
Tell me about it.
I also saw a really big, scary number about their operating loss. Did I read that right? $150 million in the red.
You did, but you have to look at the asterisk on that one. If you just glance at the summary, you see $150 million operating loss, and you think, wow, the ship is sinking.
Yeah.
But, and this is crucial, that number is heavily skewed by a one-time charge. They put aside $99 million for a litigation reserve.
So that's a legal cost, not a we can't sell T-shirts cost.
Precisely. If you strip that out and look at the adjusted operating income, they were actually positive, $26 million, which, again, beat expectations.
Okay, so the core business engine is still running. Let's go back to this intentionality strategy. We know it means doing less, but what does that actually look like in practice?
It looks like ruthless simplification. During the presentation, they said they've completed a 25% reduction in SKUs.
SKU being stock keeping unit. So you're telling me 1 out of every 4 products they used to make is just gone.
Gone. Think about that. They're trying to exit that toxic cycle of constant discounting that happens when you just have too much stuff.
Less clutter, less sales, a better brand image. I get it.
Exactly.
I also noticed there's been a bit of a shakeup in the leadership ranks.
Oh, yeah. Significant changes. They've got a new structure. Cara Trent is now Chief Merchandising Officer. Adam Peake is President of the Americas.
Yeah.
But the biggest news was about the money man.
What happened?
CFO Dave Bergman is leaving the company. after 21 years.
21 years. Wow, that is the end of an era.
It really is. And normally a CFO leaving mid-turnaround is a red flag, but they're framing it as a natural transition for this new, leaner approach.
So if they're cutting a quarter of their stuff, what made the cut? What are they banking on?
In apparel, it's the classics. Plank calls it winning with the winners.
So heat gear, cold gear.
Exactly. The base layers that put them on the map, that's still the engine. But footwear. Footwear is the problem child.
I saw that. Footwear sales down 14%. That has to hurt.
It hurts a lot. And Plank was surprisingly blunt about it. He admitted they just tried to expand the shoe assortment way too fast without the demand to back it up.
They tried to run a marathon before they could jog.
That's a great way to put it. So now, if a shoe doesn't have a clear reason to exist, it's gone. No more filler.
Harsh, but probably necessary. Did they mention any bright spots in shoes at all?
They did. They're banking on franchises now. The Velocity Elite 3 in running, for example. And in sportswear, they're really hyping up two shoes. The HB Low and the Sola.
The HB Low?
Right.
What's the story there?
It's interesting. It's a $100 price point.
$100 is a very strategic number. Not cheap, but not crazy expensive either.
Right. They see it's a massive value proposition. A gateway product, he called it.
I like that. So looking ahead, what's the guidance? Are they saying the bleeding is going to stop?
Cautiously, yes. They actually raised their full-year outlook just slightly. They now expect revenue to decline about 4%, which is a little better than the 5% they thought before.
Okay, so less bad is the goal for now. Stability. That covers the prepared remarks. But I want to get into the Q&A. This is where the real questions come out.
This was definitely the most revealing part of the call.
Let's start with the first big one. This came from Simeon Siegel at Guggenheim.
Right.
And Simeon basically asked, why should we believe you? He wanted details on their confidence in North America and timeline for when the shoe business will actually grow again.
It's the billion-dollar question, right?
Yeah.
And Plank's answer was all about the wholesale order book.
Okay, pause there for a second. Why does the wholesale order book matter so much?
Because wholesale selling to stores like Dick's Sporting Goods, it's a leading indicator. If Dick's is ordering more shirts for next fall, they believe in the brand. Plank said for the first time in a while, they're no longer seeing big declines in those orders.
So the retailers are starting to trust them again. What about the footwear timeline?
Plank was pretty honest. He admitted it needs to be bigger, but he used this phrase I liked. Skinnying up the line.
Skinnying up.
Yeah. He gave a great example with their Velocity running franchise. They used to have 6 different shoes in that one line.
6? That's too many.
Way too many. They cut it down to 4. Fewer choices, but much clearer choices. Move from chasing volume to chasing clarity.
Makes sense. Okay, next question was from Jay Saul from UBS.
Yep.
Jay asked about geography. He wanted to know if the fixes they're making in North America can work in Europe and Asia.
Right. Can this be replicated? And the response was a mix of pride and realism. Plank and the outgoing CFO Dave Bergman pointed out that EMEA is already a strong suit. Remember, it grew 9%.
Right, with JD Sports and Sports Direct.
Exactly. And then Plank dropped this fun little fact I did not see coming.
Oh, what was it?
He said Under Armour is the #1 compression brand in France.
No way. #1 in France. I would not have guessed that. What about Asia?
Asia's tougher. The upgraded APAC is a bit behind North America in this whole turnaround. It's a very promotional environment over there.
Meaning everyone is just slashing prices?
Exactly. But they think the worst declines are behind us in that region. They've got new leadership in China to try and fix it.
Okay, so Europe is solid, Asia is bottoming out. That brings us to a question from Bob Gerbil at BTI about price.
Yes.
Bob asked about good, better, best. He wanted to know if the key to all this is selling more of the best or premium stuff.
And Plank's answer here was a real moment of candor. He confirmed the strategy, but then he admitted, Under Armour has made, and this is a quote, a lot of good, some better, and nowhere near enough best.
Wow. That is a CEO admitting his own company hasn't made enough premium product.
It's a huge admission.
Yeah.
It explains so much about why their brand has slipped. And he also brought up this structural issue called global continuity.
What does that mean in plain English?
It means, does the brand look the same everywhere? Right now, he said only about 20% of their product is consistent globally.
Wait, only 20%. So if I walk into a store in London, 80% of what I see is different from a store in New York.
Exactly. It's incredibly inefficient. They want to drive that number way, way higher to create a single consistent brand voice.
That makes total sense. Okay, next up was Sam Poser from Williams Trading, and he asked about the soul of the brand.
Sam always asks the big picture questions.
He asked how they're creating an emotional connection, and he also asked about a key design figure, Yassine Saidi, who is transitioning out.
Plank's answer here was, it was vintage Kevin Plank. He said, the world doesn't need another manufacturer. It needs a dream.
The world needs a dream. You can tell he's the founder, not just some hired gun CEO.
It's passionate.
Yeah.
He said the brand needs to make people feel something again. He brought up their women's flag football campaign and the reboot of the click-clack ads.
Right, and the high school sponsorships.
Exactly, 3,000 of them. He sees that as their anchor for authenticity.
And what about the designer, Yassine Saidi?
They explained he's moving to an external advisor role. So he's still involved, but he's going back to his agency roots. They're trying to keep that red thread of design continuity.
Did they give a concrete example of this simplification in design?
They did, and it's a great one. Plank talked about their unstoppable pants. Apparently, they used to make 10 different versions of these pants.
10 versions of the same pants.
Different fabrics, drawstrings, pockets, you name it. They've cut that down to just 3 clear tiers. Good, better, best.
From 10 to 3. That leads perfectly into the next question from Peter McGoldrick at Fiscal.
Right.
Peter asked if the heavy lifting on this complexity reduction is done and how it impacts their raw materials costs.
This was my favorite anecdote of the whole call. If you want to know why Under Armour lost its way, this is it. Plank said they discovered the company was making 300 different fabrics.
300 for gym clothes.
300. But here's the kicker. Only 30 of those fabrics drove 80% of their business.
That is the 80-20 rule staring them right in the face, or in this case, the 90-10 rule.
Right. They were spending money on 270 fabrics nobody really cared about. They're cutting those aggressively. It's going to help margins a lot.
So that money just drops to the bottom line.
Not immediately. And this is the catch. Bergman, the CFO, cautioned that next year, fiscal 27, will have a full year of tariff headwinds. So these savings are basically just going to help offset those new tariff costs. They're running faster just to stay in the same place.
That's a crucial detail. Okay, finally, we had a question from Brooke Roach at Goldman Sachs.
Yes.
Brooke wanted the nitty-gritty on the future, the puts and takes for FY27, especially on the wholesale order book.
And this being Dave Bergman's final call, he took the lead but played it very safe. He wouldn't give specific FY27 guidance.
Saving it for the May call.
Right. But he did reiterate the main theme. Wholesale relationships are improving. The order book is positive.
Again, the strategy remains winning with the winners.
That's it. Double down on what works heat gear, cold gear, and make it obvious to consumers why they should pay more for the premium stuff.
So we've gone through the presentation, the Q&A. Let's zoom out. If you had to wrap this whole call up for everyone listening, what is the headline?
The headline is Stabilization and Simplification. The management team really believes the most disruptive phase of this reset is now behind them.
The demolition is done. Now it's time to rebuild.
That's a great way to put it. The focus is purely on execution now. Reducing complexities, fewer SKUs, fewer fabrics, telling better stories to get that emotional connection back, and fixing footwear by stopping the chase for empty volume.
It sounds like a company that, maybe for the first time in a while, actually knows what it is again.
I think that's fair. For a while, they wanted to be a tech company, then a fashion brand. Now they seem content to just be a really, really good performance athletic brand.
And financially.
Revenue is down, which is painful, but it was expected. The important thing is that margins and inventory are being managed tightly. And crucially, North America looks like it's starting to turn the corner.
It's a classic turnaround play. Reduce the noise, improve the product, and hope the customer comes back.
Exactly. The strategy is sound on paper. Now they just have to sell the shoes.
And that is a perfect place to leave it. We want to thank you all so much for watching this analysis.
Yeah, thanks, everyone.
If you found this breakdown helpful, please do us a favor and click that like button, share the video, and of course, subscribe to the channel so you can stay tuned for all our upcoming content. We will see you next time.